This video is created strictly for educational and informational purposes only. Nothing in this video is financial investment, legal, or tax advice. Here is the question that every single investor in America is asking in 2026. Should I keep my money in VOO and trust the growth machine of the S&P 500, or should I rotate into SCHD and lock in a powerful 3.4% dividend yield with a defensive portfolio built to survive any economic storm? The stock market has been on a wild ride in 2026. Recession fears are everywhere. Geopolitical tensions are rising. Tech stocks that drove massive gains over the last decade are facing new headwinds. And yet the S&P 500 is still near record highs. So what do you do with your money right now? This is the VOO versus SCHD battle of 2026. And this is the most important investment decision millions of American investors are wrestling with right now. According to Motley Fool and TipRanks, both published major analyses in April and May of 2026 on exactly this comparison, because search volume on this topic has exploded. In the next 10+ minutes, we are going to give you the most complete data-driven analysis of VOO versus SCHD ever produced on this channel. By the end of this video, you will know exactly which ETF belongs in your portfolio in 2026 based on your personal goals, risk tolerance, and financial situation. This is not opinion. This is data. Let us get into it. Let us start with VOO. The full name is the Vanguard S&P 500 ETF. VOO tracks the S&P 500 index, which represents the 500 largest publicly traded companies in the United States. When you buy VOO, you are buying a tiny piece of America's 500 biggest businesses across every sector, including technology, healthcare, finance, consumer goods, energy, and industrials. VOO is managed by Vanguard and carries an ultra-low expense ratio of just 0.03%. That means for every $10,000 invested, you pay only $3 per year in fees. VOO's current dividend yield is approximately 1.06%. The most recent dividend payment was $1.87 per share, paid on March 31st, 2026. Over the last 1 year, VOO has delivered a total return of 28.86%. Over the last 3 years, VOO has returned 77% total. And over the last 10 years, VOO has delivered an incredible 247% total return, representing an average annual return of 15.59%. VOO is the gold standard of long-term wealth building and represents the broadest possible bet on the continued growth of the American economy. When technology booms, VOO booms. When corporate America grows, VOO grows. The trade-off is clear. When the economy slows and tech valuations compress, VOO also feels the pain. Now let us look at the other side of this battle. SCHD stands for the Schwab U.S. Dividend Equity ETF. SCHD tracks the Dow Jones U.S. Dividend 100 Index. This is a fundamentally different approach to investing compared to VOO. Instead of owning the biggest companies in America, SCHD specifically seeks out companies that have demonstrated a long track record of paying and growing their dividends. To get into SCHD, a company must have a minimum of 10 consecutive years of dividend payments. That is 10 straight years of returning cash to shareholders without a single miss. The fund also requires companies to have strong cash flow to support their dividends and above-average yield compared to the broader market. As of May 2026, SCHD manages approximately $84 to $86 billion in assets and holds 102 to 104 individual stocks. The current dividend yield is approximately 3.35 to 3.4%. The most recent dividend payment was 26 cents per share, paid on March 30th, 2026. The expense ratio is just 0.06%, which is still extraordinarily low. SCHD's top holdings in 2026 include Chevron, ConocoPhillips, Verizon, Merck, Texas Instruments, BlackRock, Lockheed Martin, and Pfizer. These are not high-flying speculative companies. These are battle-tested businesses that have survived multiple recessions and continue to generate billions in profits and distribute them to shareholders every single quarter. Now let us get into the raw performance data, because this is where the story gets incredibly interesting and where many investors are shocked by what they see. Over the last 1 year, VOO has returned 28.86%, while SCHD has returned 24.77%. So VOO wins the 1 year battle. But look at what happened in 2026 year to date specifically. SCHD has gained approximately 15% year to date, while VOO has struggled with tech volatility and only recently emerged into positive territory for the year. This is critical because it reveals the rotation happening in real time. Money is moving from growth tech-heavy funds into defensive dividend-paying stocks. Over a 10-year horizon, VOO leads strongly with 15.59% average annual returns versus SCHD's 12.66% average annual returns. But here is the key insight that most investors miss. SCHD's total return when you include reinvested dividends is significantly stronger than the raw price return suggests. When you receive a 3.4% yield every year and reinvest those dividends during market downturns, you are buying more shares at cheaper prices. This dividend compounding during bad markets is one of SCHD's most powerful hidden advantages over pure growth funds like VOO. Let us now do a detailed comparison of the dividend income produced by each fund, because this is where SCHD absolutely dominates VOO. VOO pays a dividend yield of approximately 1.06% annually. If you invest $10,000 in VOO, you receive approximately $106 per year in dividends. If you invest $50,000, you receive approximately $530 per year. If you invest $100,000, you receive approximately $1,060 per year. Now let us look at SCHD. SCHD pays a dividend yield of approximately 3.4% annually. If you invest $10,000 in SCHD, you receive approximately $340 per year in dividends. If you invest $50,000, you receive approximately $1,700 per year. If you invest $100,000, you receive approximately $3,400 per year. That is more than 3 times the cash income generated by VOO on the same investment amount. And critically, SCHD has a proven track record of growing its dividend year after year because it only owns companies that consistently grow their dividend payments. For investors who need or want cash flow from their portfolio right now in 2026, SCHD's income advantage over VOO is simply overwhelming. When you buy VOO, you are buying concentrated exposure to the largest technology companies in America. The top 10 holdings of VOO include NVIDIA, Microsoft, Apple, Amazon, Alphabet, Meta, Berkshire Hathaway, Broadcom, Tesla, and Eli Lilly. The top 10 holdings alone make up approximately 35% of the entire fund. This means a huge portion of your VOO investment rises and falls with the performance of these mega-cap technology companies. When NVIDIA and Microsoft have a great quarter, VOO surges. When they disappoint or face regulatory headwinds, VOO suffers. SCHD takes a completely different approach. The top holdings of SCHD include Chevron, ConocoPhillips, Verizon, Merck, Texas Instruments, Pfizer, BlackRock, Lockheed Martin, Home Depot, and Cisco Systems. Notice what is missing from SCHD. There is no NVIDIA, no Apple, no Microsoft, no Amazon. Instead, SCHD is filled with energy companies, industrial companies, healthcare companies, and telecom companies that generate enormous predictable cash flows and pay reliable dividends quarter after quarter regardless of what is happening with AI valuations or tech market sentiment. The correlation between VOO and SCHD is just 0.41 according to Portfolios Lab data from May 2026. This means they move very differently from each other. When tech sells off, VOO falls hard, but SCHD often holds steady or even rises because money rotates into defensive dividend stocks. This low correlation is one of the most powerful reasons why combining both ETFs in your portfolio can actually reduce your overall risk while maintaining growth potential. When it comes to fees, both VOO and SCHD are champions of low-cost investing. VOO charges just 0.03% per year, which is among the absolute lowest expense ratios of any ETF in the world. SCHD charges 0.06% per year, which is twice VOO's fee, but still extraordinarily cheap compared to the broader fund industry, where average expense ratios range from 0.3 to 0.9%. To put this in real numbers, if you invest $100,000 in VOO, you pay $30 per year in management fees. If you invest $100,000 in SCHD, you pay $60 per year. The difference is only $30 per year on a $100,000 investment. That is completely insignificant when SCHD is generating $3,400 per year in dividend income versus VOO's $1,060. Both funds passed the cost efficiency test with flying colors. The small fee difference should never be the deciding factor when choosing between these two powerful ETFs. What matters far more is your investment goals and your need for income versus growth. Now let us talk about risk, because this is critically important for investors making decisions in the uncertain environment of 2026. According to Portfolios Lab data, VOO has a volatility of 2.96%, while SCHD has a slightly higher volatility of 3.45%. Now, this might surprise many investors who assumed SCHD would be less volatile. The reason is that while SCHD avoids tech stocks, it concentrates heavily in energy and financial companies, which can also experience significant volatility. However, when we look at maximum drawdown, both funds have been remarkably similar, with SCHD dropping a maximum of 33.37% versus VOO dropping 33.99% at their worst points. This means in a major crash, both funds will experience significant drawdowns. The key difference is in the recovery. SCHD investors who were receiving and reinvesting those quarterly dividends during the crash were accumulating more shares at lower prices, accelerating their recovery. VOO investors with its low 1.06% yield had far less cash coming in during the downturn to put to work at lower prices. In terms of risk-adjusted returns as measured by the Sharpe ratio, VOO currently has a slightly higher Sharpe ratio of 2.59 versus SCHD's 2.42 over the trailing 12 months. But this metric shifts over time, and SCHD's Sharpe ratio has been higher than VOO's during periods of economic uncertainty and market stress. So what does the current 2026 market environment tell us about which ETF to favor right now? According to Motley Fool analysis from April 2026, SCHD is the top-performing U.S. dividend ETF so far in 2026. The article states that as the economy slows, geopolitical tensions remain, and inflation rises, it is probably going to make investors less likely to push back into growth stocks in the near term. Conditions favor the continued outperformance of defensive and dividend-paying stocks. TipRanks analysis from May 2026 confirms that SCHD takes a more defensive stance and focuses on companies with steady cash flow and strong balance sheets, which is exactly what the current uncertain environment rewards. However, the data also shows that over the longer term of 10 years or more, VOO has consistently delivered stronger total returns of 15.59% annually versus SCHD's 12.66% annually. This creates a fascinating dynamic. In the short-term, near-term environment of 2026, SCHD may be the better performer. But for investors with a 10 to 20-year horizon who can ride out near-term volatility, VOO has historically delivered superior total wealth accumulation. So who should choose VOO in 2026? VOO is the right choice for investors who have a long investment horizon of 10 years or more and do not need immediate income from their investment. It is perfect for young investors in their 20s and 30s who are in the accumulation phase of their investment journey and want maximum long-term wealth building. VOO is ideal for investors who are comfortable watching their portfolio drop 20 to 30% during a market downturn and staying invested through the recovery. It works well for investors who want the simplest possible exposure to the entire U.S. economy with one single ultra-low-cost fund. And it is excellent for investors who believe that American technology companies will continue driving economic growth over the next decade and beyond. SCHD is the right choice for investors who want or need cash income from their investment right now in 2026. It is perfect for investors approaching retirement within the next 5 to 10 years who are transitioning from accumulation to income generation. SCHD is ideal for investors who are deeply concerned about near-term volatility and want a portfolio of defensive businesses that generate reliable profits. It works beautifully for investors who want to build a dividend income stream that grows every year as the underlying companies increase their dividend payments. And it is an excellent choice for investors who want meaningful diversification away from the massive technology concentration that exists inside VOO. Here is the most powerful insight of this entire video. You do not have to choose just one. The data shows that VOO and SCHD have a correlation of only 0.41, meaning they behave very differently from each other in different market environments. By combining VOO and SCHD in your portfolio, you can capture the long-term growth potential of the S&P 500 through VOO, while simultaneously generating meaningful dividend income and defensive stability through SCHD. A popular allocation strategy that many U.S. investors are implementing in 2026 is 60% VOO and 40% SCHD. This gives you strong growth exposure while also generating a blended dividend yield of approximately 2%, which is significantly higher than VOO alone. Another strategy is 70% VOO and 30% SCHD for growth-focused investors who still want some income. Or for more conservative investors closer to retirement, 50% SCHD and 50% VOO provides excellent balance of income and growth. The key is that owning both reduces your overall portfolio risk through diversification while keeping your money working in two of the most proven low-cost ETFs ever created. Here is the complete data-driven comparison of VOO versus SCHD for May 2026. VOO Vanguard S&P 500 ETF. Expense ratio 0.03%. Dividend yield 1.06%. 1-year return 28.86%. 3-year total return 77%. 10-year average annual return 15.59%. Holdings 500 companies. Top sector technology 30+%. AUM massive. Dividend paid quarterly. Maximum drawdown 33.99%. SCHD Schwab US Dividend Equity ETF. Expense ratio 0.06%. Dividend yield 3.35 to 3.4%. 1-year return 24.77%. 2026 year-to-date return 15% outperforming VOO. 10-year average annual return 12.66%. Holdings 102 to 104 companies. Top sectors energy, healthcare, financials. AUM $84 to $86 billion. Dividend paid quarterly. Maximum drawdown 33.37%. Correlation between VOO and SCHD is 0.41, providing excellent diversification benefit when held together. So here is the final verdict for 2026. If you are young, have a long-time horizon, and do not need income, VOO is your long-term wealth-building machine. If you need income now, want defensive stability, and are concerned about near-term market volatility, SCHD is your fortress. And if you want the best of both worlds, combine both ETFs in your portfolio for growth plus income plus diversification. Now we want to hear from you. In 2026, are you Team VOO, Team SCHD, or do you hold both in your portfolio? Drop your strategy in the comments below and tell us your allocation percentage. This is the most important investing conversation of 2026, and your fellow investors want to know what you are doing with your money. If this deep dive brought you real value, please hit the like button right now and subscribe to ETF Holdings USA. We are incredibly close to our goal of 1,000 subscribers, and every single subscription helps us continue delivering the most data-driven ETF analysis on YouTube. New video every single day. See you in the next one. This video is for educational purposes only, not financial advice.